Hey gang, welcome to Time in the Market episode 5. I took a small break during the holidays, but I'm back now with another edition of Time in the Market, the long-term investing show. I'm going to talk about whether or not I think the stock market is overpriced going into 2020. As you know, I'm a long-term investor, so I'm in it for the long run. But I know that question is on everybody's mind. After all, the stock market just had an absolutely amazing year, returning somewhere near 30%, and just pretty much everything was a winner. Prices kept going up, multiples kept expanding. If you were an investor in the market, if you had significant amounts of money in the market, you did great. I know I did. Things were awesome, but anytime you have a year like this one, it leaves you wondering whether or not it can continue or if things will change going forward. So I'll talk about that in a little bit of detail soon, and then I'll also review my my portfolio and how things are doing since the last update. As you know, on this channel, I talk about my long-term investing approach. I have two portfolios that I follow on M1 Finance, and I hope you enjoy following along with those. And that's where I'll start today. I'll do a quick update on the portfolios, and then I will jump into the meat of the show, talking about whether the stock market is priced attractively right now, or if it's potentially due for a correction of some sort. And as always, those things are hard to tell, so we'll just kind of toss around some of my ideas and let you guys think about what those mean to you and your investing style. So I've got my dividend aristocrat portfolio up on the page. I did an episode about this portfolio a couple of weeks ago if you want to check that out on my channel. This is a portfolio that follows the S&P 500 dividend aristocrats, 57 stocks that have raised their dividends 25 years in a row and are in the S&P 500. So these are long-term dividend payers and dividend raisers. And this portfolio actually is probably going to grow soon, and I'll do a video on that soon. As the year turned over, some additional stocks may be added to the dividend aristocrats portfolio. So I kind of have to see where I want to put those in the portfolio and how I want to position them, because M1 Finance kind of limits you to whole numbers as far as your targeting goes. So I'll have to have some stocks in at 2% and some stocks in at 1%, and I'll do a quick review of that whenever I look into the new dividend aristocrat stocks. And I think there might be 5, but those haven't been formally announced yet by the S&P 500 dividend aristocrats index. So I'll wait until that happens. That usually happens somewhere around the middle of January. There's no rush right now. It's been about a month since I did an update, and the dividend aristocrats have kind of followed the market in that month. Things have been pretty decent in December. There's been a couple of volatile days towards the end of the year, and there's another one today. But overall, things are in the positives. If we look at where we started at the beginning of December, we were at about $8,800. A combination of market growth, dividends, and additions to the portfolio have brought me to just shy of $10,000 in this portfolio. It's about $670 in net cash flow, $163 in market gain, $20 in dividends. It's always nice to see the dividends start to grow. This is a dividend paying portfolio. It yields just in the 2.5% range and growing. So it's really nice to see these dividends start to grow and get bigger and bigger as the totals grow, because eventually, this is going to be a passive income source for me. It already is, but it's a relatively small passive income source. If we look at the individual stocks in here in the last month, there's a couple of winners, probably a couple of losers. WFC Corporation, Stanley Black & Decker, Archer Daniels, Midland are doing great for me. Cardinal Health, Ben Franklin, Leggett, FRT, Hormel, a bit on the other end. But that's the beauty of a portfolio and what M1 Finance allows you to do. There's dynamic rebalancing going on. So every time I put in money, it kind of puts in those dollars into areas that are underallocated. So I'm kind of buying the recent losers that may potentially become the winners in the future. And that's the goal with this portfolio, kind of go along with that narrative and grow the portfolio in the long run. If you look at the activity, even since the year turned over, I've already gotten a couple of dividends here. Not a lot, but again, dividends are just the cherry on top of the growth sundae that you get with stocks. I love seeing them. It's kind of like owning a company or owning a piece of real estate that's paying you some sort of rent or something like that. So every couple of days, I'll get something from the various companies I own. And right now, that something is relatively small. We're talking about sub $1 dividends for a lot of these companies right now. But, a couple of years down the line, we'll be seeing these numbers be a lot higher. And that's really the point of this journey. It's a combination of growth, growing the stocks themselves due to price appreciation, multiple expansion, but also getting dividends and growing those dividends due to putting more money into the stocks, but also the companies themselves growing the dividends, because this is what this portfolio is about. It's about dividend growth, and the strategy is really about dividend growth investing. And again, if you want more information about why I think this portfolio is worthwhile and why it's better than the S&P 500, see the Dividend Aristocrats dividend growth investing video I did a couple weeks back, and I'll link to that in the video description below if you'd like to watch that. My second portfolio I have here is the industry investments portfolio. This one's more focused on industries that I think are going to do particularly well in the future, more on the growth side of things versus the value side of things, and less on the dividend side of things, because most of these companies are companies that have high operating margins, generate a lot of profit, but are reinvesting a lot of that profit into capital expenditures or R&D or whatever that's going to help them grow their revenue, versus paying the revenue out in the form of dividends, like the dividend aristocrats do, right? There's two different types of investments, or really the same investment, but there's two different ways to invest. There's a dividend growth investing strategy, or a dividend strategy, where companies pay out their profits in the form of dividends, or pay out a large portion of their profits in the form of dividends. There's some stock appreciation with those stocks, because there's still some profit that go into growth and reinvestment and stuff like that, but it's generally less. So there's a total return of X, but more of that total return is driven by dividends than it is by price appreciation, versus these type of growth industry investment stocks that are in this portfolio. This portfolio is more so focused on the companies that are making a profit, or some even that aren't but will in the future, but are reinvesting their profits into growth versus paying out dividends. So there's still price appreciation and total return, as there is with the Dividend Aristocrats portfolio, but that total return is more focused on that price appreciation side of things versus the dividend side of things. And there's benefits to both, right? The Dividend Aristocrats portfolio with dividend focus gives you passive income, gives you income you can use, gives you potentially more security based on historical returns. They do better in downturns, whereas this portfolio gives you less cash flow or less passive income that you could actually use, but gives you potentially more returns in a good market, but also at a higher risk, since historically these have done worse in down markets than something like a Dividend Aristocrat portfolio, one focused on income. Because when there's a down market, people kind of run towards safety, which is more so the dividend paying stocks. And when there's a bull market, people run towards growth stocks, and people run towards growing companies, which is kind of the focus of this portfolio. So if you look at the 1-year return of this, it's a bit higher than the Dividend Aristocrats, 25%, whereas the other one was about 22%. If you look at the 1-month return, the other one was sitting at about a 2% return. This one's nearly at 6%, and most of that comes from market gains versus dividends. Even though this portfolio is larger, we've only gotten about $12 in dividends. The other portfolio is smaller, and we had about $20 in dividends. So these are the two differences. If you look at the 1-month return, things have done really well here. That's a big return number in 1 month. It's been a real good month for growth stocks in some of these industries. We started at 11.3. We ended up at 12.4. I only put in $500 here, so I put in less than the other portfolio, but we grew more due to the market gains that we're seeing. As far as the industries that went well in the last month, you've got autonomous vehicles, the e-commerce industry did great, pets and animals did great. Some of the other industries did fine as well, all of them in the positives, but obviously there's some winners here. If I just look at some of the individual stocks within any of these slices that I have here, JD did fantastic, Shopify, Etsy, Wayfair, a lot of these companies are doing really well in the last month. Again, this is a long-term portfolio, so I'm not overly concerned about one month performance. But it's always nice to see. You can't complain about nice returns. But honestly, if the portfolio was heading the other way, I'd still be okay with that, because I'm investing for more than 10 years here. I'm not going to need this money for quite a bit of time. I'm trying to grow this portfolio to a sizable amount where I can eventually depend on the passive income from the Dividend Aristocrats portfolio and the growth in this portfolio to kind of fund my lifestyle. And that's the long-term goal here. So I'll keep buying whether the market is up. I'll keep buying whether the market is down. I really don't plan to sell. I'll do a review from time to time on some of these stocks. I did a review like that on the industry investments portfolio in my last episode, where I talked about why I like to invest in this portfolio, the growth prospects of a portfolio like this, the focus on operating and profit margin, but also the potential risks of a portfolio like this. And based on that analysis, if you kind of go back to some of the trading that I did here, I did remove a couple of companies from this portfolio that I had in there when I first started it. It's kind of refreshing the portfolio with a bigger focus on those things that I talked about: growth, operating margin, profit margin, companies that I believe in, companies that have good sales growth, and a good trajectory in the future. And I just didn't feel like Molson, General Motors, or Uber really fit that criteria, so I removed them and replaced them with other companies in the portfolio. So if you'd like to watch that video, I'll link it in the episode description below. Or you can also just go click on my name and check out episode 4. I believe that was episode 4. So those are the two portfolios. If we kind of look at where we're sitting in relation to where we were as of the last episode, we're up $400 or so on the Aristocrats side. We're just shy of $1,000 on the industry bet side. So overall, we went from $21,000 to about $22,172 in portfolio totals. And then from that number, I can kind of figure out what's my forward income, how much dividends does this portfolio generate going forward, and that's about $342. That's a go-forward projection based on the current totals. What I also did for this episode is I kind of calculated how has this portfolio done for me in terms of dividends in the past. And really, I only started putting money into this portfolio in a big way somewhere around August and September, maybe a bit earlier, a couple of months before I started the YouTube series chronicling the portfolios. And you can kind of see that the trend is pretty obvious. There's a very big uptick in June, and continues up and down, but also it's generally up as far as the trend goes. The payout in December was about $34, whereas the payout last December was about $6. So we're seeing $169 in 2019 dividends. On a go-forward basis, I'm projecting to get $342 in 2020 dividends, because the portfolio has grown so much since the beginning of 2019, and it's going to continue to grow. So hopefully by the time 2020, the end of 2020 rolls around, this December is much, much higher than the $34 that we saw this year, because I'm going to keep pumping money into this portfolio, and I'm going to enjoy watching it grow, whether the market is up or down. So that's one of the things I wanted to talk about. The market was up quite a bit in 2019. Everybody saw that. Everybody kind of realized that, hey, things seem to be going well. There aren't too many alternatives. Money kept flowing into the market, and as a consequence of that, the market did fantastic. The S&P was up 30%. My portfolios were up, nearly 30% as well. It's kind of hard to compare because I'm continuing to put money into these portfolios. So a year-over-year comparison is difficult to do, because the S&P 500 return of 30% is just, if you bought on January 1st of 2019 and you sold on December 31st of 2019, your 30% return is locked in. But since I'm buying, every week, every other week, there's a time component to things. The money I put in last month only returned like 2%, but the money I put in January 1st of 2019 probably returned 30% or more. So it's difficult to compare those two, but I think if you watch the other two videos, I kind of did a comparison of how do these portfolios perform in the long run, because that's really what matters. A 1-year comparison doesn't really give you any relevant information. Sometimes your portfolio will lag the S&P 500. What matters is, does it beat it in the long run? And based on the data I've shown in those two videos, the Dividend Aristocrats portfolio does beat the S&P 500 since the data is available for that portfolio around 1990. My industry-focused growth portfolio is a bit harder to gauge, because a lot of the companies that are in it didn't exist that long ago. Some of them, IPO'd in the last decade. Some of them IPO'd in the decade before that. The data that's available, the portfolio has beaten the S&P 500 by quite a bit. But again, we've been in a bull market, and growth companies will do that in a bull market. So I wouldn't read too much into that. There's certainly a lot of risk with the growth portfolio if you are looking to invest in something like that. So those are the dividends. Hopefully these will grow quite a bit as we head into 2020. But I'll try to do an analysis like this every once in a while so you can kind of see the progression of current dividends alongside my assumption about forward income based on the current yield of the two portfolios that I am investing in. So now we'll get to the meat of the episode. Kind of, is the stock market overvalued right now? And that's the $1 million question, isn't it? If you look at some of the financial publications, there's a lot of articles saying a lot of things about the stock market. It's a great time to invest. It's a terrible time to invest. It's an okay time to invest. The stock market is crashing anytime it drops 300 points. The stock market is poised for awesome success anytime it drops, it gains 300 points. It's very hard to look at a website, any financial website, and kind of get a good gauge of what's going on in the stock market. And there's a reason for that. And the reason for that is nobody knows what the stock market's going to do any given year. You can look at stock market predictions going back to whenever, and nobody's consistent. Almost everybody's wrong. Stuff happens that nobody can predict. If you told me that the stock market was going to return 30% going into 2019, I would have said, that sounds unlikely. Now, starting in 2020, I'm looking at the returns. I'm like, well, I was definitely wrong. But the beautiful thing about my investment style is that it didn't matter that I was wrong. What time in the market is about, it's about putting your money in the market and staying in the market. There's a saying that spawned the name of this channel. It's called time in the market beats timing the market. And it does. The data proves out that time in the market beats timing the market. And what that really means is that if you buy a stock and hold it, or more so if you buy a stock index fund and hold it, because individual stocks have risks, whereas this may not play out the way you think it does. If you buy a stock index fund and hold it for a long period of time, you will do better than a person who buys and sells depending on whatever factors they may be using. And this is proven out in a lot of financial literature. It's proven out in the data that you see. It's the reason that an index fund beats 80% of professional mutual fund managers. So if you look at data going back to as long as they've tracked it, anywhere between 70 to 80% of professional mutual fund managers, people who manage money for a living, who get paid to do this, who charge high expense fees to trade stocks, pick individual stocks based on what they think is good, based on what they think is bad, do worse than simply staying in the market. The reason for that is that it's very hard to know when the right time to sell comes, and it's also very hard to know when the right time to buy comes, right? There's a lot of people who probably looked at the stock market in 2018 or 2019, and they said, ooh, the PE ratios are, I have this PE ratio and a CAPE ratio here. The PE ratios are 25. That's much higher than they have been since, well, really going back to like 2003, if you ignore 2009, which was an aberration due to the financial crisis. The PE ratio in 2018 was 25, and this is a gap PE ratio. I don't really want to keep buying stocks at this level. I should probably sell all my stuff. And they were kind of proven right for about a minute. The return in 2018 was negative, but if they didn't buy in right away because the PE ratios are still kind of high, they missed this entire 30% rise. So overall, they just lost out quite a bit. So they maybe made a little bit of money, or maybe made a smart decision if they sold before it dropped 4%. But if they didn't buy in before it rose 30%, they really lost out. And that's really the problem, right? It's impossible to know exactly when to sell, and it's impossible to know exactly when to buy. So at the end of 2018, and it's one of the reasons that 2019 had such a great return, at the end of 2018 in December, there was a little bit of a market kerfuffle where the market dropped about 20% and people were panicking. People were selling. People were doing whatever they could. So people probably bought at a high, sold it when it dropped 20%, never bought back again, and then it rose 30% from there. And it's like, you're doing the wrong thing, buddy. What you should have done is you should have bought it. You should have kept it. When it dropped 20%, you should have bought more, and then you should have just stuck it out. And yeah, maybe it would have dropped more, but you should have just kept buying. That's what 2008 proved. If you kind of look at some of the returns, 2008 was one of the worst markets ever. But if you look at the valuation of 2008 on a CAPE basis, it was probably one of the best times to buy. And maybe this is a good segue to talk about, whether or not valuations drive returns, because I did a little calculation here that gives me the return for the annualized return for each individual year. And if I paste that next to the CAPE ratios, you can kind of see where it starts to make sense to buy stocks. And if you're not familiar with the CAPE ratio is a cyclically adjusted price to earnings ratio. So basically, instead of a price over earnings that you typically see here, which can kind of be misleading because, in 2009, which was one of the best times to buy stocks, the PE ratio was a 70.9 because earnings dropped like a stone due to a recession, essentially, due to the financial crisis. So a PE ratio can sometimes be misleading. Sometimes it's not when there's not a recession. If you look at 2002, 2000 and 2001, PE ratios were very high for a reason, because stocks were priced very high and earnings weren't really going through a recession, at least initially. But the CAPE kind of gets rid of those problems because it looks at price divided by the average of 10 years of earnings. So it gives you a longer term view on the earnings side. So it smooths out the weirdness that comes with PE ratios. And then also on the PE ratio side, we've got an estimate here of 24.4. It's a GAAP estimate. This also uses GAAP estimates, but again, it's over 10 years, so it's smoother. And people may also look at non-GAAP data too, so it kind of confuses the area there as well. And this earnings ratio kind of gets rid of that problem because it's really using earnings from the previous 10 years, and those are going to be less susceptible to non-GAAP adjustments across the entire board than any given year, because certain given years may have bigger non-GAAP adjustments than others. So let's look at what this means. So right now, as of the 2nd of January, 2020, the S&P 500 CAPE, the cyclically adjusted price to earnings ratio, is sitting at 31.2. That's the highest number since 2018, which we kind of talked about before as potentially a bad time to invest due to high PE ratios. And it's also one of the highest numbers since 2007, 2006, 2005, back to 2002, 2001, 2000. So certainly 31.2 seems high. If you look at the historical average of the market since 1990, exclusive of this year, the CAPE is 25%, so it's about 18% lower than what it is today. So historically, on average, you've been able to buy the market at prices that were about 18% lower than they are today. So from that perspective, are things expensive today? Yeah, things are expensive today. But that doesn't really tell you everything. As I said before, the CAPE or the PE ratio can't be looked at in a bubble. If you ignore some of these earlier months, it seems like most of the modern stock market era has been in the 20 plus range and often in the 25 plus range. And maybe that's just the new market norm, right? Things have changed quite a bit since the early 90s. Accounting rules have changed. The type of companies that are in the market have changed. The rise of the internet has brought about companies that are more operating margin focused, right? The fact that companies exist today that have like 50 to 60% operating margins is driving higher PE ratios, higher CAPE ratios. That didn't really happen in the 80s and the 90s, where PE ratios and CAPE ratios were much lower. The other thing to look at is what kind of returns can you expect from a 31.23? Because at the end of the day, if you're asking yourself, is the stock market overvalued? You're asking yourself, am I going to make any money off of the stock market? And if you look at the stock market historically, the answer to that, at least in the long run, is yes. Am I going to make any money by buying stocks at a CAPE of 31.2 or a PE of 24.4? The answer to that is yes, in the long run. Because you can look at years like January 2000, where if you bought at the beginning of January 2000, the return is still positive, even though the CAPE is 40% higher than it is today, right? So you're paying 40% more in January 2000 than you are in January 2020. And if you were to buy in January 2020 and hold until today, you would still get a 6% annual return since then, which is not a bad return. It's not great, but it's not bad in relation to all the other things you can get. The problem is that that return takes quite a bit of time to materialize. If you look at some of the returns here, you don't really get back to positive. You go from 2000 at 258,000 to 2009 at 258,000. So even though you made a 6% annualized return, that return really only happened in the last decade. So you had to wait 20 years to get there, because the first 9 years were losses. You know, you kind of made some of it back by 2006. You went from 258 to 300, so you were up. You were up by 2005 technically, and a bit more up by 2006, but then you lost it again in 2009. And that's not really great, right? If you look at even the return from 2007, the highest it was, or the return was relatively small. The annual return was relatively small. I'm thinking like 2% or something like that. So the problem is that it's hard for an investor to kind of stick out that long and be okay with a small return like that if they bought in 2000, right? You may think, hey, a 6% return is pretty good, but that 6% return is from January 2000 to January 2020. That's a long time to kind of wait for that return. And between January 2000 and January 2010, that return might have been closer to 1 or 2%, right? And that's not fine. That wouldn't be something that you'd be very happy with. So what that tells me is that the CAPE does drive return, because you can kind of see it that when the CAPE gets high, when you're talking about 36s, 43s, 40s, even 32s, the return is much lower than average. You know, we've got an average return here, and an average is not the best way to look at this, but an average return of 11.1% when the CAPE is 25, and the return is 6% when it's 43. So it's much, much smaller. And not only that, but it's 6% across 20 years. So it may take much longer for that to materialize, and there may be some pain along the way. Same thing with a 36, same thing with a 40, same thing with a 32. So does the opposite hold true? And for the most part, it does, right? If you look at some of the longer term returns here, the best return in the market was if you bought in 2009, when the CAPE was at 15. Since then, you've almost gotten a 15% annualized return. But even in the low 20s here, you're talking about 13, 13, 14, 14, right? And it kind of gets murky over here because these numbers are so swayed by this 30% return. And even if you're being negative, let's say you go back here and you say in 2009, let's say 2009 never existed, so we go back to a 0. Does the same kind of theory hold true? So we're ignoring 2009 as an aberration, and you're being a completely negative person. Does it still make sense to invest in the market when the CAPE is at 31, right? And it still kind of does, right? You're looking at a CAPE of 43, a 40, a 36. I mean, these are still returns of some sort, even if you ignore the fact that the stock market returned 0 and returned 30 rather in 2019. You're still getting some decent returns. They're not great. They're probably matching what bonds did in that time frame, or maybe even doing a bit less good, but they're still returning something, right? They're beating inflation. And that's when you're buying at the absolute worst time, when CAPEs were super high, and they're not that high yet. Again, if the CAPE was at 43 right now, I'd probably be like, ooh, that's kind of rough. But the CAPE is at 33, and that kind of tells you that you can expect a positive return in the long run. It's not going to be as great as it was last year, probably. It's not going to be as great as it was here when you're talking about 11 to 14% returns when the CAPE was 15. But it's still going to be potentially okay. So one thing you have to remember is that the CAPE is based on two things, right? It's the price and the earnings. So you have to keep two things in mind when you look at that, right? The price is where it is. What are the expectations for earnings going forward? Are they zero? Are they shrinking? Are they growing? Because that's going to drive your returns as well. And the reality is that I think earnings are expected to go up about 9% in 2020. So there's going to be some expansion of the earnings side of things. So that may help on the multiple side of things. But the reality is that you're looking at a higher CAPE than usual. So you have to temper your expectations in terms of the returns you're going to get. When you went into 2019, right, you probably weren't expecting 30%. And the reality is I'm not expecting 30% in 2020 because earnings are going to grow 9%. In order for us to get to a 30% return, we'd have to expand the CAPE even more and probably get to a point where it's sort of in this range now, in the 30s, in the mid to high 30s. And at that point, you're starting to get to a point where long-term returns are getting smaller and smaller and smaller. And that's kind of the reality of the market we're in. I think you have to temper your expectations as to what you're going to get. You have to be ready for some sort of pullback, potentially, because anytime you get into some of these 30 CAPEs, they don't always stick around that long, right? And there's a reason for that. Prices drop. Either prices drop or earnings get better, right? So you've got two situations. Again, it doesn't mean that it's going to happen anytime soon because we're at a 31. We could potentially be right here. Right, we could be in 1998 right now. And what happened in 1998? Well, the stock market went up 28%, and then the stock market went up 21% again the year after. So, and if you invested in 98, you still made about 7.5% in the long run, despite the fact that you lost your value of the stocks that you owned dropped quite a bit in these 3 years. So that's the problem with market timing, right? It's always hard to tell where you are in the cycle. And right now we're 10, 11 years into a bull market. Some may argue that it's not really a bull market 11 years running because in 2019, or rather at the end of 2018, we had a 20% drop and that kind of stopped the bull market and restarted a new one. Whatever you believe, the reality is that the CAPEs are higher than they've historically been, even if you ignore some of these numbers, the higher numbers, or if you do include them, even if you go 98, which is the expansion of, or 97, the expansion of the internet bubble. This is when the internet began. This is when potentially the stock market changed to something completely different. You're talking about a 27.5 CAPE, even if that is the new normal. 27.5 divided by 31.2 is 12% higher. Are we 12% overpriced? Maybe. Does it matter to me? Not really, right? Because the reality is the stock market does not exist in a bubble, and I don't have any alternates for my money here. And this is really where the crux of the issue comes in. When people talk about, hey, the stock market is overpriced, overpriced in relation to what, right? Is it overpriced in relation to the history of the stock market? Yeah, probably. I just kind of gave you two different time samples where we're either 20% overpriced or 12% overpriced based on a CAPE ratio. Are we overpriced in relation to where we were in 2012? Yeah, I mean, I could buy stocks at half the price in 2009 that I can now in relation to their earnings, cyclically adjusted earnings. Was I happier buying stocks in 2009 than I was in 2020? Yeah. Was I happier buying stocks in 2011, 12, 13, 10? Yeah. Even 2016? Yeah. But that doesn't mean that I'm not happy buying stocks now, because I know that even though the CAPE's high, I can still get pretty good returns, at least on a short-term basis. I don't really know what's going to happen on a long-term basis. On a long-term basis, it's probably going to be more muted. If I'm buying stocks at a CAPE of 31, I'm not expecting a 14.5% return in the long run, right? Because I'm paying double for that. Realistically, I'm probably expecting half that return, if in the long run. Because if I look at what happened in January 2, when I was buying stocks at a CAPE of 30.2, which is close to where it is now, I got about an 8% return in the long run. If I look at what happened in 98, where it's slightly higher than it was now, it's about 7.5% in the long run. Now, that's the key word here, in the long run, because as I mentioned before, some of these higher CAPE months, if I bought in 99 or 1998, the first couple of years after buying those stocks weren't that great because earnings had to catch up to the prices that people were willing to pay for these companies, right? If you're paying $43 for $1 of earnings, you're expecting a lot from these companies. And if that doesn't materialize, and if it takes 7 years for those to get there, the prices are going to drop pretty quickly. And that's what happened. Earnings grew, but they didn't grow at the pace that people expected. So prices dropped, multiples shrunk. And eventually those earnings got to a point where even with the shrunken multiples, you were making money, right? If you're paying $43 for $1 of earnings, and this dollar becomes $1.25, and now you're only willing to pay $25 for $1.25, right? Your stock is suddenly worth $31.25. So you've lost money, even though earnings are growing. But if later those earnings go to $2, and you're still willing to pay $25 for those $2 of earnings, you're making money now, right? Because your stock price is higher than it was before. So even though you've lost money in the short term, in the long term, you start making money again. And again, as if this grows to 30 again, and you're still willing to pay $25 for it, now your return's pretty decent. You've almost doubled your money. But this takes a while to happen. It takes a while for $1 of earnings to grow to $2 to $3 before you start making money. And if you pay too much for that $1 of earnings, as you may be doing now, your returns may be muted, right? Anytime you're paying $31 for a $1 of earnings, which is essentially what's happening now, you're going to do worse than if you're paying $21 for a $1 of earnings, or if you're paying $15 for a $1 of earnings. But you'll do better than if you're paying $43 for a $1 of earnings. And the other side of the coin is you never know what's going to happen with what people are willing to pay for this $1 of earnings, because the 31 CAPE, in relation to what we look at in 2021, maybe a deal. What if 2021 people are willing to pay $40 for a $1 of earnings? So earnings are going to grow a bit, and suddenly the multiples expand to $40. You get another huge year, right? That's what happened this year. People are willing to pay more for a $1 of earnings than they did last year. Earnings grew, and you're making money. And why are people willing to do that? Well, this is the other aspect of things. There's no alternatives to this. If you look at the valuation of stocks from an earnings yield perspective, and then compare it to a treasury rate, where you can, sometimes the safe thing to do with your money in relation to putting it in stocks is to put it in a treasury bond. It's hard to do that. So if we look at earnings yield, which is the reverse of the CAPE, so if you're basically paying through your earnings yield is 3.2% right now. I'm paying 3.2. I'm getting 3.2% in earnings. 100 divided by 31.2 essentially is my earnings yield. In 2000, I was getting 2.28% of earnings yield. That's pretty low. But it's pretty low in relation to what? And that's really what the crux of the problem is when you're talking about whether or not the stock market is overvalued right now. In the year 2000, when I was paying $43 for each $1 of earning, or my earnings yield was 2.2%, I could have said, hey, that's kind of expensive. Maybe I'll sell those stocks and I'll put them into bonds, 10-year bonds, which are giving me a 6.6% return, because my yield's pretty small. I don't expect earnings to grow that much, and my long-term return is going to be 6%. So does it make sense to put it in a 10-year treasury bond that has no risk at 6.6%? Yeah. There's an alternative here, right? My yields here, my earnings yields are low because the PE, the CAPE ratios are high. But I have an alternative here, and that was the case all throughout the 90s, all throughout the early 2000s. If I felt the stock markets were overpriced, if I was paying too high a CAPE for the earnings that I was getting, if my earnings yield was low, I could go to the bond market and I could get 6 to 8%, even 4% into the mid 2000s, right? That's not a bad yield, right? I had an alternative. I could go to the bond market and I could say, the risk for me on this end, on the stock end, is too high. I'm going to look elsewhere to grow my money. And that elsewhere was treasuries. It was bonds. It was risk-free bonds where I could get 6 to 8% in the 90s, early 2000s. I could get 4% was pretty good in 2006, 2007. But what do I do now? It's obvious here, if the yield is 2.2%, and 6.6%. Obviously, this 2.2% has room to grow, so there's some upside here, whereas the 6.6% is locked in. I kind of would invest in treasuries here. What do I do in 2020? My yield is 3.2%, and it's got room to grow. What's my alternative? A 10-year bond yielding 1.8%. So I'm paying a P ratio, CAPE ratio of 31, but I'm paying a 55.5 P ratio or CAPE ratio for a bond. Why would I put my money in bonds? So it's like, that's why stock markets are so much higher right now than they are in these other months, and that's why it's sort of supportable, right? Yeah, you're paying more for earnings than you have historically, but you've got no real good alternative because yields are just so freaking low. You know, I'd rather pay a CAPE of 31 or a P ratio of 24 or whatever for stocks that are going to grow, that are going to continue growing my dividends, that are going to continue growing earnings, and going to give some sort of yield, even if it's 7 to 8% historically or lower, than something that's going to lock me in at 2%. And obviously there's benefits to the treasury in that it's going to be essentially 2% every year for 10 years, right? But there's no growth there. There's no upside. If I want to grow wealth, as I talked about in one of my earlier episodes about compound growth, I can't do it at 1.8%. Maybe if I already had $1 billion and I was worried about a 31 CAPE being too expensive, I'd put it into 2% treasuries. I'd put more of my money into 2% treasuries. Or if I was, 60 years old or 70 years old and didn't want to risk a downturn where prices drop 30 to 40%, I'd put some or more of my money into bonds. But right now, as a young person, as someone who's just starting with investing, as someone who's got a relatively small amount of sum of money in relative terms, I can't depend on a 2% treasury. I have to look at the stock market, and realistically, even at a CAPE of 31, the stock market is a much better opportunity than a 10-year treasury. Excuse me. And obviously there's other alternative investments, but not a lot of people have access to those. There's real estate, gold, silver, stuff like that. I don't really deal with those too much. Some of that is too speculative. Real estate, I think, is a fantastic investment if you've got the time and wherewithal to do it. I think being a landlord in certain areas is probably one of the best ways to make your fortune. But I just don't have it in me, and I live in a very expensive cost of living area where renting is not, or buying a place and renting it out is just not cost feasible. But in certain markets, it's fantastic. But it's just not for me. So when I look at these two things, I look at the S&P 500, even at a CAPE of 31, where it's been for the last couple of years and has done pretty damn well, if I say so myself. It's much better than the alternative of a 10-year treasury. And honestly, is the stock market overvalued right now? Historically, yes. Are the returns going to be lower than they have in the past? If history is any guide, yes. Is there going to be some sort of return to the mean? And when I say the mean, I'm talking about a CAPE of, let's say, 25, 27, depending on how long of a period you look at. Probably. Is it going to happen this year? Who the hell knows? Maybe, maybe not. It's possible that we're at a CAPE of 31 and the stock market expands even further. And if you sell now, you'll miss out. I think a lot of people missed out on 2019 because they were spooked by what happened at the end of 2018 and said, oh, snaps. I'm starting 2019 at a 28. History tells me that it should be in the 20s. I better sell out. Boom, the stock market goes up 30%. You missed out one of the best years in quite a long time. You've missed on, there's a study that says if you miss like the best 10 days in the stock market, you lose out a couple percent in annual return. And those are huge, right? That's huge. A couple percent in annual return is amazing. Just watch my video on compound growth for that. And that's the problem with saying that, hey, is the stock market overvalued? Yes, definitely sell. I don't know. If anybody tells you that it's overvalued, they don't know what you're talking about. Stop watching their videos, stop reading their stuff. The reality is, who the hell knows? It seems a bit frothy. If I'm going to be putting more money into the market, which I will, I'm probably going to steer more of that money into the Dividend Aristocrats portfolio side versus the growth portfolio right now, because those typically do better in a correction. I think a correction is going to happen in the next year or 2 or 3. It doesn't have to, right? It's possible that the CAPE just stays at 31. I mean, let's say the CAPE stays at 31 and earnings increase at 9%. You've got a 9% return. That's not bad. Let's say the CAPE expands, earnings do increase at 9%. You've got a bigger than that return. Let's say the CAPE shrinks. If it shrinks by less than 9%, you've still got some sort of return. And then maybe it'll expand again in the future. These are all things that are impossible to tell. All that's possible to tell is that, hey, even at CAPEs that were higher than now, the returns were positive in the long run. They could be negative in the short run. There's a risk for that. So you can definitely lose quite a bit. If there's a recession, stocks will drop no matter what. They'll drop more if the CAPE is higher than if the CAPE was lower. Let's say the recession happens and we're at a CAPE of 31 and it drops to a CAPE of 15, you could lose 50% of your money in a short amount of time. That's the risk with stocks. You got to be able to take that. If your investing horizon is short, keep that in mind. Don't be unaware of that, because the worst thing you can do is if you buy at 31 and it drops to 15 and you sell at 15 and it goes back to 31 3 years later, you're just the worst investor ever, right? And that's what timing the market does to you sometimes. You buy high, you sell low, you start fearing missing out again, you buy high again, you sell low again. You're just doing it wrong, right? You should buy high, you should buy low, you should buy all of the time. You should sell only when you need to sell, and that should be rarely, because you should also keep an emergency fund on the side. You should not invest all of your money because you don't want to be forced to sell when you don't want to. So if you are an investor, if you're investing now, keep 3 to 6 to 12 months of cash on the side, simply to cover expenses in the case of a recession, in the case of a stock downturn, because you don't want to have to be forced to sell. If a recession comes around, you lose your job, etc., etc., etc. This is what long-term investing is about. It's about risk management. It's about having a long-term horizon. And even at a CAPE of 31, I think stocks are worth investing in. They're a bit expensive, probably, but if you look at the treasury, are they really that expensive? They're at a 31 against a 1.8% treasury. A 3.2% earnings yield is better than a 1.8% treasury yield in 2002. And the return since then was 8%. You were getting a 3.3% earnings yield, slightly better than today, but that was against a 5% treasury yield. So it's obvious that people have the potential to sell off quite a bit more than they do if the treasury yield is attractive than they do now, when the treasury yield just sucks, right? It's not even potentially covering inflation. So CAPE's high. It's high historically. Returns will probably be muted, but alternatives aren't great. Earnings are still going to keep growing. Stocks are still a good long-term investment, but keep in mind that we're 11 years into a bull market. CAPE's higher than it normally is. You're paying a bit more for each dollar of earnings than you normally were. That doesn't mean that it's going to be a long-term loser, but it does mean it could be a short-term loser. But long-term, you'll probably do okay. You'll do worse than you would if the CAPE was lower, but I don't know if this is enough to make me stop investing. I'm a long-term investor. Maybe if the CAPE gets to the 40s, I'd be like, ooh, maybe I'll lock in some profits. But until then, I just don't see why you would want to stop investing. Sure, you could hold money on the side, but I think you're at risk of missing out. You get the fear of missing out. You get the FOMO. You buy at the wrong time. The stocks drop. The risk you've got here is the CAPE is at 31. You say, it's too high. I'm going to sell today. By the time the year rolls around, it's gone up 30% again like it did last year. The CAPE is suddenly at a 36. You're like, ooh, I missed out. I better buy in. It drops to a 29 again, and hey, things are bad. Sure, if you knew exactly when things are going to start dropping, and where things are going to start rising, you should sell before it starts dropping. You should buy before it starts rising, but you're not Nostradamus. You can't predict any of that stuff. Neither can I. So my advice to you, friends, is, hey, keep buying. Don't overload on growth securities, but they're still worthwhile. I'm still going to put money into my industry investments account that is focused on growth industries, but maybe focus on some of the safer, and I'm doing air quotes here, safer stocks like dividend aristocrats that, if the stock market drops 40%, this may only drop 20%. Still going to drop, but maybe slightly less. And then, keep investing. Have a long-term time frame. Ignore the noise of the market. Ignore daily drops. Buy when the market's up. Buy when the market's down. Don't try to time the market. Invest for the long run, and you'll do okay. As long as you're buying every year, as long as you have adequate cash on the side for any emergencies, and don't get forced to sell at an inopportune time, you'll be okay. Whether you buy today, whether you buy 6 months from now, whether you bought in 2007, right before the stock market crashed, whether you bought in 2008, right before the stock market crashed, you did okay. Even if you bought at the worst possible time when the CAPE was 43, you still got a 6% return until now. You didn't do great for a bit of time. The first couple of years were kind of murky because these corrections take a while to happen. So, have a long-term perspective. If you're buying for the next 1 to 2 to 3 years, stocks may not be the best place for you, but if you're buying for 5 to 10 to 20 years from now, keep buying. Don't worry about the CAPE. Certainly, you'd prefer it to be lower, but it probably will be the next couple of years. And if you are concerned about the prices today and have $100,000 to invest, don't lump sum it. Just do $5,000 every month, $1,000 every month, whatever you're comfortable with. Lump summing in the long run is the best type of investment, but you got to be comfortable with your investment strategy. So do whatever you're going to do. Just be aware that stocks can drop. At this CAPE ratio, they're more likely to drop than at a much lower CAPE ratios. But I think long term, you're still going to do okay. And really, there are no viable alternatives. So happy investing. Let me know what you think about this video. Let me know if you disagree. Let me know if you agree. And otherwise, have a great day. And I'll be back soon with more videos.